Does Treasury function in a bank? Let's learn more about this topic in today's video. I'm a learning partner Sushila Hariharan, and if you're interested in a career in investment banking operations, OTC derivatives, trade life cycle, and fund accounting, do subscribe to my YouTube channel where we provide content-centric, research-focused videos on these topics. In a bank, the treasury function is perhaps the most important function, and let me explain to you why. The treasury role comprises literally everything that starts from managing the day to day funding requirements for the bank right up to meeting the regulatory requirements of the bank. These include submission of reports in Basel form, etc. etc. So, treasury is a very critical function in a bank because it helps move money. As we already know, a bank is a financial institution that accepts money from general public and gives different kinds of loans to different investors. The deposits come in in the form of current accounts, savings accounts, and fixed deposits, and the loans that are disbursed across tenures, across maturities, across credit profiles of borrowers. So, what happens in a bank is that because they're dealing with intangible money all the time, and they're looking at meeting the requirements of depositors and shareholders, it's very important that they manage the day to day funding of the bank. This day to day funding of the bank is carried out by the Treasury Division. The Treasury Division in a bank comprises two distinct desks. The first desk is the foreign exchange desk, also called as the FX desk, and the FX desk is responsible for trading in FX currencies across the world. The largest FX currency pair that is traded by most banks across the world is in USD EUR, which is the trade between the US dollar and the euro currency. The second division of the bank, which manages the local domestic money markets, is the bond division, the bonds division, and the money markets division. In most banks, both of them operate with each other because they look at trading and investing in bonds, also called as fixed income securities, across various maturities. So you have two distinct divisions, that is the FX division and the money market division. The money market division in any bank is perhaps the sole responsibility of traders who trade in government securities, treasury bills, treasury notes, as well as in corporate bonds, commercial paper, and certificates of deposits. The main objective of the money market division is to trade in securities that give the requirement of liquidity and profitability. Okay? The most liquid asset for anybody, including banks, is obviously cash. But cash does not generate any returns. If at all anything, you might have to be afraid that the robber or nowadays the cyber hacker might steal away the cash from you. Therefore, it's a smart thing that the banks do because they have to constantly generate returns year after year. They have to be able to invest the money in securities across different credit ratings, across different credit profiles, across different maturities, so that they take care of the liquidity requirements of the bank. The banks are also obliged to maintain statutory reserves called as CrR and SLR in India. CrR refers to cash reserve ratio and SLR refers to statutory liquidity ratio. Both these ratios ensure that the banks do not lend every rupee that they get by way of deposits. This critical aspect of banking is important because it keeps in mind that the depositor's money is safe and secure, and at the same time the banks are able to lend out the rest of the money in order to make profits. The money market division, headed by junior dealers as well as senior dealers, take trading positions in money market securities. The money market securities that are most widely traded in large economies like US, India, Japan, etc., are the Treasury Bills. Treasury Bills, shortened as T-bills, are the bills maturing in less than 1 year. But since we're using the term treasury, it implies that the government has issued them. So, in a sense, it gives a sense of comfort to the investor that because the government has issued these bonds, there is a very, very low chance of a default. In fact, perhaps no default at all. These treasury bills are the way that governments borrow money from banks, mutual funds, and other recognized investment vehicles in order to manage their short term working capital requirements. So, why do banks invest in treasury bills? Because it's a very, very liquid and highly traded asset class. So, banks, in their constant struggle with liquidity and profitability, I will not call it struggle, I should call it a challenge, always look towards investing in treasury bills. The second type of treasury instrument that banks also invest in are treasury bonds. In the US market, they're called as treasuries. In the Indian market, they're called as GSECs, standing for government securities. These are bonds that vary between various maturities beyond 1 year, right up to 20 years, sometimes even 30 years, as long as that. The treasury bonds again are long term instruments, and because they're issued by the government, they have the term treasury attached to it. Since they're issued by the government, there's a sense of comfort, there's a sense of what should we say, uh, relief, if I may say so, that bonds are not going to go into a default category. So the money market division and the bond division look at trading in a large number of instruments that are issued by the government because they get some bit of comfort, and the government yields are also very attractive nowadays given the high inflation that has been persistent and prevalent in the last few quarters. The second kind of instruments that the money market and the bond desk invest in are instruments issued by corporates. These include commercial paper, which are traded in the money markets because of their short-term nature. They are issued by corporates for a period less than 1 year, and they typically are used to fund the corporates' working capital requirements. What about governments? Do governments also issue commercial paper? No, not really. That's why we're calling it treasury bills. Commercial paper is a term we're using to describe the instruments that are being issued by corporates for a short period of time. The corporates also issue a variety of bonds: fixed rate bonds, SOFR linked bonds, convertible bonds, non convertible bonds, straight bonds, bonds with call option, bonds with put option, bonds that give an early maturity, bonds that pay coupon on regular basis, bonds that have a balloon repayment, and so on and so forth. And therefore, there's a wide diaspora of bonds that investors can choose from, especially those that are issued by corporates. Obviously, the coupon rate paid by corporates on their bonds will be a tad higher than what is paid by the government simply because of the credit profile of the corporates. Corporates have a different uh, rating system or rating mechanism, starting from investment grade bonds right up to speculative bonds, in which the the investment profile fits right in. The issuer's credit ratings over here play a very important role, and sometimes banks might want to invest in bonds that are not necessarily rated at the very highest category because then they don't earn very much returns on those kind of bonds, or the margin of difference between a coupon paid by a treasury bond and by a government bond is very, very small. So that explains briefly what the corporate what the bank money markets and bond division does, which really manages domestic liquidity. At the other end of the spectrum is a very buoyant FX market division. The FX market division looks at trading in foreign exchange. Now, this is global markets we are talking about because the largest currency pairs that are traded in the world are USD, EUR, USD, JPY, etc. And these currencies are very, very volatile. This $1 trillion market literally trades 24 hours, with the earliest market zone starting off with the Tokyo markets, moving westwards towards Singapore, India, Dubai, London, New York markets. The largest FX market in the world continues. At the other end of the spectrum is the Forex Market division, which trades in global markets, especially across different time zones. In foreign exchange, the main objective, of course, is to hedge client positions, which could include large exporting clients, large importing clients, and they are looking to convert either USD into INR or INR into USD or any other currency. The FX division also undertakes a lot of speculative trading in foreign exchange, because small point movement in foreign exchange results into magnificent profits or very huge losses sometimes if the trading position is carried forward for a very long time. So the foreign exchange division trades largely on two positions. One is for clients. These are corporate clients, large exporters. India is a very large software exporter, is a very large oil importer. So we are constantly trading, the banks in India are constantly trading in foreign exchange. The foreign exchange market is very, very volatile, and you know, it is susceptible to very large economic issues that affect one of the two currencies in the currency pair. So, for example, if the dollar if the Federal Reserve is decreasing the US dollar interest rates, then we find the impact on many currency pairs in the world because of this single action. So, therefore, it's very important that the forex dealers and the manage the client portfolios. So importers, exporters, hedge funds, speculators, etc., take very large trading positions running into millions of dollars in the foreign exchange market. When I say foreign exchange market, I mean the Interbank FX market. The Interbank FX market is a market which trades in foreign exchange with minimum lot sizes of $1 million. Okay, not the kind that we're looking at for trading in small amounts, like a few thousands of dollars that we may need for a student education abroad or tourist abroad, etc. But literally trading positions that run into millions of dollars for speculative activities, as well as for covering the client receivables or payables. This FX activity is exposed to global foreign exchange movements, global interest rate movements, and global political movements. Okay, see what has happened in the case of Argentina, see what's happened in the case of Brazil, and you understand that politics plays a very important role in determining the foreign exchange superiority, strengthening or weakening of any of the currencies in the world. So the FX desk trades in foreign exchange, and they generate profits. The profits that are generated by the foreign exchange desk and the money market desk add to the profitability of the bank. The Treasury division, thus, is perhaps one of the most important divisions in the bank, helping out not just the corporate clients but also institutional clients, and in the process managing both the liquidity as well as profitability of the bank.